You're listening to the Financial Source podcast on YouTube.
All right, so for today's deep dive, we're looking at a market that is, well, it's basically just holding its breath.
It really is.
The sources we're digging into are painting this picture of a full market analysis, but with a very specific mood.
Consolidation with a defensive bias.
Exactly. It feels like the calm before the storm. And that storm is, of course, the U.S. Consumer Price Index release.
It's the definition of a wait-and-see environment. But consolidation here isn't just, prices moving sideways on a chart. It's more that conviction is incredibly low. Investors are caught between these conflicting signals, these macro cross-currents, and nobody wants to make a big move before that CPI data drops.
And usually when we talk about cross-currents, we mean, good economic data versus bad. But this time it seems like the signals from the central banks themselves are diverging.
That's the crucial part. There's a real split.
Between the Federal Reserve in the U.S. and the Bank of Japan.
A huge one. So on the U.S. side, you have comments from Fed voter Mirren. And what he's saying is, he's pushing back against the fear that the labor market is cracking.
Okay.
His argument is that we're seeing supply-side improvements, things like productivity gains, supply chains finally healing.
Which lets the economy grow without kicking off more inflation.
Exactly. It's the soft landing narrative. It means the Fed can keep rates higher for longer without actually choking the economy. It's a pretty optimistic view, actually.
It is. But then you look over at Japan.
And it's the complete opposite story. Board member Tamura is out there warning that inflation in Japan is becoming sticky and persistent.
So they're getting ready to tighten.
He's laying the groundwork for it, basically signaling more rate hikes are on the table.
And that matters for everyone, because if Japan hikes while the U.S. holds, that changes the whole flow of capital, doesn't it?
It changes everything. And you can already see that defensiveness playing out in currencies. USD/JPY is just hovering right around 153.
Which is a very sensitive level.
It is. That's where traders start getting nervous about a sharp reversal. The dollar itself is just kind of flat, directionless, because nobody knows which central bank narrative is going to win.
And speaking of those defensive moves, what's happening in the bond market, I saw U.S. Treasuries are pretty much paused.
Treading water. But German bonds are trading near their year-to-date highs.
So a flight to safety, but into European debt.
It's a classic flight to safety, yeah, but maybe with a twist. If you're worried about U.S.-specific volatility, German bonds are seen as that safe haven without the American baggage.
So money's just parking itself.
Exactly. Not making any big bets.
We see that in commodities too, right? Gold is up about 1.1%.
Pure hedging. But oil is the real anomaly here. You'd think with all the geopolitical risk, crude would be spiking, but it's totally flat.
It does seem odd. Why?
Well, this is one of the most interesting nuggets in the research. It's not just about demand, it's about a specific rumor. There are comments circulating from Donald Trump about a potential deal with Iran. And the market is starting to price in the possibility that a U.S.-Iran agreement could bring a lot of Iranian oil back online.
So the expectation of more supply is basically canceling out the war risk premium.
It's capping the price, precisely, which explains why energy isn't playing along with gold in this fear trade.
So you have this complete tug of war. On one side, the Fed's optimism. On the other, this defensive mood in gold and bonds.
And sitting right in the middle, making everything more complicated, is the volatility in AI and the tech sector.
That's a huge factor. We can't forget that a lot of this hesitation isn't just about inflation. It's about whether the AI trade has gone too far.
It's creating a ceiling on risk appetite, which brings us right back to the catalyst.
The CPI data. The referee, as you said.
It is.
Okay, so let's walk through the scenarios. If we get a soft CPI inflation cools off, what happens?
If inflation cools, the market assumes the Fed has room to cut rates. So, yields drop. When U.S. yields drop, the dollar weakens. Bonds rally, and risk appetite probably comes flooding back into stock.
And if it comes in hot?
The complete inverse.
Yeah.
The market fears the Fed has to stay high or even hike again. Yields would spike, capital gets sucked into the dollar, and equities, especially those high-flying tech stocks, would likely see a defensive rotation.
So the strategic takeaway here is that the macro picture isn't necessarily falling apart.
Not at all.
But the conviction to actually act is just paralyzed until we get that confirmation on inflation.
We are absolutely in a holding pattern. The fundamentals are arguably okay, but the uncertainty is just too high.
It really is.
Yeah.
Which, leads me to a final thought for our listeners. The analysis lists AI volatility as a major constraint, right alongside inflation and geopolitics. Is it possible we're underestimating just how much tech sentiment itself is driving this whole consolidation phase? We're all watching the Fed, but maybe the real story is just that investors are terrified of a tech correction, no matter what the CPI says.
It's a very valid question. Macro data matters, but sometimes market structure matters more.
Well, thanks for listening to The Deep Dive. Keep your eyes on the charts.